We have Sanjeev Prasad, the Managing Director and Co-Head at Kotak Institutional Equities, now joining us with what he's making of things. Sanjeev, always a pleasure having you here on the program. Thanks very much. What's top of mind, Sanjeev? The market's almost like Teflon coated. And not just our market. I mean, I'm talking about global markets, right? Flare up in Middle East, and I think there's a fair bit of recency bias as well, that nothing really, all these things will pass quickly. Although oil prices are up $15 since the time this this has happened. Your thoughts, Sanjeev?
Well, that's the state of the play, I guess, at this point in time. People have been pretty bullish for the last 4 years now, and until recently, the strategy worked. Any panic, any negative news, people have bought into that. Buy or dips has been the strategy, which has worked okay until now. But having said that, if you look at India, the performance has been pretty bad actually over the last year or so. If you look at MSCI India index, it's actually flat in the last 1 year versus about 11% return both for the MSCI emerging market index and the MSCI world index. So it's actually been a big underperformer. Even if you look at the last 6 months, pretty much the same situation. It's been a flat market in dollar terms against MSCI world index, which are 5%, MSCI emerging market index, which are 9%. So it's really been a big underperformer. Even if you extend it to the broader markets, let's say the mid cap and small cap, even there's a problem. Nifty is up 6% in rupee terms last 1 year. Nifty mid cap 100 index, if you look at that as a benchmark, it's about 5% up. Small cap index about 1% up. So that's the whole issue. The market is definitely quoted, but it's not gone anywhere for the last year or so. So on the one side, you have a lot of hopes, on economic recovery, earnings recovery, bullish sentiment, and so on and so forth. On the other side, you have the reality of very high valuations, which have probably resulted in not much of returns as far as the market is concerned.
Sanjeev, hi, morning, great to have you on. So absolutely on that valuation debate, that's a point well taken. But if I park that debate aside for just a second and just talk about earnings. Last time when we spoke, I think it was in May, you had told us that you were expecting roughly 10% earnings growth in FY26, which is at the lower end of the analyst spectrum. Since then, the one thing that's changed is a very generous RBI with this bazooka of rate cuts, CRR cuts and whatnot. Does that make you any more optimistic on a pickup in consumption, maybe better earnings growth? Anything that's changed since you heard from the RBI?
A lot of change, unfortunately, the negative also. On the one side, you have RBI, whatever it has done on the monetary side. But on the other side, whatever hopes there was of, extra benefit to India on the fiscal side through lower oil prices, that's completely gone away. Now, coming to the earnings part, and we'll talk about the monetary and fiscal later on. As of now, we are looking at about 12% growth in Nifty 50 index for FY 2026. But do keep in mind the fact that almost 2/3 of the earnings is coming from very specific sectors and factors, namely metal mining sector that contributes to almost slightly more than 20% of the incremental earnings of the Nifty 50 index, and that is largely linked to the fact of higher domestic profitability for the steel companies compared to FY 2025 when profitability was on the lower side. This is all linked to safeguard duties. It's got nothing to do with the performance of the economy. Same way if you look at oil and gas sector, that contributes to almost 30% of the incremental profits. That's again coming more from ONGC's gas pricing formula. And then you have telecom sector, that again contributes about 11% of the incremental profits. That's coming on the back of expected increase in outputs of the telecom sector, that is RP. So it's got nothing really to do with the state of the economy, actually. On the other side, if you look at consumption, it's been weak. The hopes are that will recover as we go forward. There are a few triggers out there, one which you already talked about, RBI rate cut. But do keep in mind the fact that, it is done. 100 basis point is what the RBI has delivered in this rate cutting cycle, and that's it. 100 basis point rate cut doesn't change anything as far as the household EMIs, etc. is concerned, especially if you look at the low price, low tenure tickets. It doesn't really matter actually as far as EMIs are concerned. Then there is some hope of recovery in rural, which is ongoing. Thankfully, we had a decent 2024 summer crop, decent 2025 winter crop. Expectation that 2025 summer crop would also be fine, linked to a good monsoon. You had some tax cuts, which is positive for at least upper middle income, high income households. But that's about it. The bigger structural issues which we have been constantly highlighting, creation of good quality jobs, it's still not really picking pace.
That's important, Sanjeev. It's really important to hear you say that. I'm just reiterating for our viewers. The view that you have is that 100 basis points rate cuts don't do much when it comes to disposable incomes within households to drive that consumption spend. There's the income tax cut. There's also some hope building up that we'll get some sort of a GST cut this time around when the council meets. They'll rationalize some rates, maybe do away with some slabs. But basically, I mean, to complete that point, short point is you don't see a big pickup in consumption. Is that right?
It's everything little bit, it will add up, but it's not going to be a big recovery. So as I said, there are three, four factors that will all add up to some recovery in consumption. But on the other side, look at what's happening on the investment side. There's a clear slowdown as far as the government budget is concerned. You look at the central government numbers, looking at 7% growth overall. A lot of that is also coming from non-traditional capex items, which probably will not get spent. And all this fiscal hopes, in fact, we were also very hopeful until a week back that it could be some stimulus coming on the fiscal side. In fact, we written a big note on this, how much potential savings could be there because of lower food prices and how much of that can translate into higher additional, household saving if the government was to choose to pass on, the benefit of lower global food prices to household through cuts to retail prices. Unfortunately, that story has, disappeared in a matter of a week, right? Given food prices have jumped to $70 a barrel now. Compared to when we written the note, it was $65 a barrel. $10 a barrel change is about $17 billion negative impact on the economy. The whole thesis of a big improvement in, household ability to spend linked to lower food prices, lower, diesel gasoline prices, that's evaporated now. And that's the whole challenge over here. So we were hopeful that between a combination of monetary stimulus, which the RBI delivered, and some fiscal stimulus, which could come on the back of lower oil prices, and some, minor, positives on the consumption side, which we just discussed, there could be some recovery on the consumption side. But unfortunately, monetary side is done, in my view. Fiscal doesn't look like there is any scope to do anything, given where food prices are. And whatever small recovery you can see on the back of other small things, fine, that will continue.
Hi, Sanjeev. Good morning. Good to hear your cautious commentary this morning. Growth and earnings growth of 10 to 12% on the Nifty. The markets have gone through a time-wise correction, consumption not picking up as well. But there'll be a couple of pockets, Sanjeev, that you like. If you could name a couple of them. I think in the past you were comfortable with the insurance companies and they actually have done quite well. Do you continue to hold on to that positive stance? And since we're talking about BFSI, I think even from the financial basket, I think the PSU banking names is something you like. You continue to like both these two?
In the last 12, 18 months, we have been quite positive on the entire BFSI space. Banks and BFCs, insurance, and thankfully they have done reasonably well. So in the context of the broader market, we are still okay with that space. Also, the stocks have done well. The valuations have now become, I would say, somewhere getting to fair territory, at least for the large cap, private banks. I don't think there's much scope for re-rating. Having said that, given what we are seeing on the deposit rates, thankfully, it looks like banks are in a position to cut deposit rates at the same time, because there was one worry which was building up was that there would be a big squeeze on the NIMs of the banks, especially the private banks, which have a large portion of their lending book linked to external benchmark linked rate. Yeah. But given the fact that even the PSU banks seem to be cutting, savings deposit rate, actually that gives some flexibility to the private bank also now. So hopefully you won't see that big a squeeze on the NIMs compared to earlier worries. Credit side, we are not seeing any real issues, especially in the secured book. It's absolutely, fine pretty much across the banking sector. So if that is a construct, then I think banks still look okay. Valuations are reasonable, I would say, not much scope for re-rating. But having said that, as long as the books are growing linked to the ROE, most of the PSU banks will do about 11-12% ROE in FY 2026. Private banks will do somewhere between 13 to 16%. So if that's the return I'm looking at, assuming no re-rating, de-rating, that's a fantastic return for this kind of a market. NBFCs seem to be in a good position linked to the attractive interest rates. So possibly could see some margin expansion over there, but I won't be too hopeful because RBI is pretty insistent. Looks like, that there could be a quick transmission of lower interest rates to the broader system. Insurance, we kind of like, it's a good long-term structural story, valuation are reasonable. So yeah, so BFSI space still very, very constructive, I would say, in the context of the fact that other sectors' valuations are very, very high, especially the entire consumption market. At least I struggle with the valuations over there.
No, absolutely. By the way, the number one volume-led gainer today, once again, is Sterlite Technologies. Sterlite Tech is up almost 10%. It'll come up on your screen. And like a one-way rocket move. And we've had many of these, right? I mean, down and out, but complete, how do I call it? I mean, change of fortunes very quickly. So from 60 rupees, on the 10th of May, stock's at about 115 odd rupees now. And of course, bulk of this move has come in the last 5 or 6 odd trading sessions. The BSN order, of course, came through. But still, I mean, it's a very, very large, significant move. Apart from that, I mean, there is Power India, which is up 2.5%. Data Patterns is up at 3%. Jubilant, Engraver, another bit of a turn has been Reliance Infra. I think continues to power ahead. 30%, 35% this year so far. Reliance Power is up even more, 60, 70% this year. I guess people looking for... it's also a reflection of, I guess, the lack of ideas that, you're having to look harder and harder and harder. Is that the way you'd look at it, Sanjeev? I mean, some of these big turns, suddenly we've had many of those in the recent past.
I won't get into specific stocks, but there seems to be a lot of excitement around some of these, I don't know, you call them whatever, I call them narrative stocks, whether they are a defense space or, railways, etc., etc. There's a lot of excitement around these names. I mean, the problem is, many of the narratives simply do not stack up. Look at railways as an example. I did a note also on that. What is the excitement for? I have no idea. For the simple reason, if you look at the government's railway budget, it's flat for the last 3 years. FY24, FY26, it's stuck at 2.6 trillion rupees. A lot of low-hanging fruit as far as railway capex already done in the form of existing network, whatever maximization had to be done, and large parts has to be done. Electrification is now up to 90% of the railway network compared to about 50%, if I remember correctly, in about 2015, 2016. Yeah. Same way, a lot of investment has been made in signaling safety systems, etc., which has resulted in faster passenger and freight train movement, which has resulted in ordering of more railway stock, rolling stock, that is, coaches, wagons, etc., etc. So a lot of that thing is done. If you have flat capex as far as railway budget is concerned, why should there be excitement around railway stocks, first of all? And more importantly, look at the valuations of many of these railway companies. You look at something like Rail Vikas Nigam as an example. It's a $10 billion market cap company. Its PBT in FY 2025 was about $200 million. I mean, what sense does it make, to be honest with you? It's trading at about 8-9 times price to book. But huge excitement over there. IRFC, $20 billion market cap company. It's a railway finance company. The loan book has been flat, profits have been flat, trading at more than 3.5 times price to book. The private banks don't get that kind of multiples, right? And here I have a wholesale borrower, wholesale lender model getting 3.5 times price to book. There have a lot of such funny stuff happening in the market, maybe linked to whatever sentiment, but at least I am not in the camp that I want to get into any of these names, far away from these names.
Okay, all right. Point well noted that you will be far, far away from a lot of these names that have been, well, I mean, someone will call them hype stocks, narrative stocks, but they've really been, capturing or captivating investors' imagination. Thanks very much. Great conversation as always, Sanjeev. We look forward to the next one. You have a good rest of the day.